staying with the markets. And Craig Erlam is a senior market analyst at the foreign exchange trading platform OANDA, and he joins us now. Welcome back to the programme, Craig. So as we heard from John there, trouble not confined to the US markets. This is really a global sell-off, isn't it?
It is. And in Europe, it actually started on Thursday with the ECB. Christine Lagarde was very hawkish, looked very concerned, sounded very concerned about inflation, talking up the prospects of a rate hike in July, another rate hike in September, maybe even a 50 basis point rate hike, growing support for that, more to come after that as well. It seems like there's growing concern about fragmentation in the euro area, with Italian yields today hitting 4% for the first time in many years. We're kind of going back to around a year after Mario Draghi's whatever it takes speech to see these kinds of levels in the European bond market, particularly in the periphery. So the issues around linked to the US CPI on Friday really is widespread, and it feels like that realization has finally hit home this week that we could potentially be heading for a global recession. The high interest rates, high inflation, and a massive cost of living crisis is catching up.
So challenging conditions all round. Is there any suggestion how long this might last or how low things might go?
Well, it's hard to say, because I think what we wanted to see by now, if you take a look at the sell-off at the start of this year, it was driven by inflation running hotter than expected and lasting longer than expected. But it was expected to peak around April, May time. And what we were hoping for then, what the expectation was, that once it peaked, and it peaked a lot higher than previously thought, the expectation was then it would fall quite rapidly because of base effects comparisons with last year, because fuel prices starting to stabilise, or at least energy prices on the larger market. And what's actually happened is it initially decelerated slower, and then it jumped up again on Friday, as we saw in the US. And we're seeing very high levels in Europe. We're expecting double-digit inflation here in the UK. And all of a sudden, this peak being higher and not decelerating, the combination of those two means that the fear is very much arrived in these markets. And the question is, how long can it last? Well, it'll last as long as inflation lasts, because if central banks are raising interest rates and raising interest rates aggressively, but inflation just isn't coming down as quickly as it needs to, then the fear will remain. If we see a month or two where the data shows signs that it is starting to cool, and I think we will start to see risk appetite return.
And you said the dreaded words, global recession. John was talking about the possibility of a US recession, but what about elsewhere? Who do you think might be at risk?
Well, I think everyone's at risk. I mean, if we look at the UK, for example, it was about 3 months ago that the Bank of England almost conceded defeat, started waving the white flag, said that later this year, inflation will hit double digits and the UK will effectively have a recession. Other countries have been slower. Other countries have been more resilient and said that, no, I think we can avoid a recession. The US in particular has said repeatedly, soft landing, soft landing, soft landing, although history doesn't really support their cause when it comes to raising rates as fast as they're intending to. We look at the markets now. Europe is selling heavily. US is selling heavily. Look at the emerging markets with the currencies selling heavily. This is typically what we'll see when we are heading for a recession. There's no guarantees, and as the previous guest alluded to, we saw the slight inversion of the 2 and 10 yield curve. That typically suggests the recession is coming at some point within the next 2 years. But we haven't gone deep into an inversion at this point. So the markets aren't completely convinced, and there is time to save that. There is time for that to reverse and for the data to start to convince us otherwise, and for the pressures to start to cede. But at this point of time, the path of travel is not very good.
And we have got plenty of central banks meeting in the coming days globally. Some decisive action has been taken, but do you think now is the time for more? And what can they do?
I think more is essential. What we want to avoid is this negative feedback loop with regards to the kind of wage price spiral and to inflation going from being a 6 to 12 month, 18-month issue to being a decade issue. That's what central banks want to avoid. That's why they've been so heavily criticised for not moving earlier. Try and nip this in the bud. There's certain inflation they can't control. They can't control the cost of imports. They can't control supply side shortages. They can't control COVID restrictions in China leading to supply chain issues. They can't control the price of fuel. There is domestic inflation pressures that they can try to get to grips with. And had they moved sooner and more aggressively, then potentially that could have made life a little bit easier further down the road. But it does increase the pain that we're going to be ultimately facing now. The Federal Reserve has already raised interest rates by 50 basis points once. They're likely to do so again on Wednesday, maybe even 75, although I think they may hold off another meeting for that. The ECB could do the same in September. The Bank of England's expected to raise by 25 basis points, but again, you wouldn't be surprised if they ramp up to 50 basis points because while they're waving the white flag, inflation is still expected to go double digits. And if they're only raising rates by 25 basis points while telling us inflation is going to hit more than 10%, then it really does send a very strange message to everyone.
OK, Craig Erlam, great to get your thoughts today. That's Craig Erlam from OANDA.